Okay, we probably could get going. I see some more people joining as time goes by, but I think that that's also 9:02, so probably we could start. What do you think, Matthew?
Yeah, I think so.
Okay, so let's go over probably the slide 2. We'll talk about, I'll do the introduction, and let's talk about what we intend to cover in this webinar. Well, first of all, thanks everybody for joining us in this webinar. We'll try to bring in a succinct and interesting way the main developments that we see out there in the financial markets, the macroeconomy, financial markets, with a special focus in currencies, obviously. Then we'll try to give you a review of this Omicron new variant and the potential for disruption, economic disruption, and market disruption that we see. Spoiler, we are for now quite sanguine. We don't expect massive disruption there. We will be then going to some detail as to the prospects for policy tightening out of the 3 main central banks that our clients are interested in: the Federal Reserve, the European Central Bank, and the Bank of England. This is the big story of 2021 and 2022, the different how the different banks are reacting to inflation. And we'll wrap it up by giving you our forecast and our predictions for what will be the main currency market trends in 2022. Then we'll open the floor for some Q&A at the end. So if you go to slide 4, I believe. The main drivers of the FX market. First of all, as you probably have noticed, the dead calm and low volatility that had rule over markets during most of the pandemic, surprisingly enough, has dissipated. We're seeing sharper moves, we're seeing volatility pick up, and we're seeing clear trends being established among the main interest, the main currency exchanges. The economy continues to recover well. This is we're not changing our view that the economic growth will, if anything, tend to surprise to the upside. Workers and companies are clearly learning to live with the virus, with the pandemic. Clear example is that the latest German and Austrian lockdowns seem to have much less effect than people expected on the PMI indices of business activity, which are probably the most immediate gauges of economic activity. The second key driver is that inflationary pressures are building globally, that this is not a transitory phenomenon, that this has to do with a general supply problem, and the response from central banks and fiscal authorities everywhere has been to pump up demand in response to what turned out to be a supply problem. Central banks seem to have, to some extent, missed the boat on this inflation processes, and we see this actually as, even though we're generally optimistic on the economy, the main risk is that central banks continue to fall behind the curve, and this results in inflation pressures to continue to build and a sharper response from central banks down the line. But we'll go into depth on that later. The Omicron variant, of course, has come in the scene the last week, presents a risk to global growth. There were some notable sell-offs last week in markets, but let's keep it in stride. The S&P 500 is still very close to record highs. Even at the worst of the sell-off, of the Omicron-related sell-off last week, it was not even 6% off of its highs, and back off, and it was actually, it had barely given up a month of gains. And the economic impact is unclear given how little information we have, both on the health consequences of mutation and how quickly vaccines or booster shots will be available against this new variant. So if we go to the next slide, again, the critical driver for at least in the G10 space, and increasingly also in the emerging market space, will be the degree and the speed at which the different central banks normalize policy. It is clear that worldwide there seems to be an imbalance between extremely stimulative monetary policy with rates either at 0 or below 0 or close to 0 in most countries, while inflation shoots up globally. We can see here this in figure 2 that except perhaps for Japan, which has its own internal dynamics, always has had for the last 2 decades, inflation is a global phenomenon. Most of the differences between the US, the Eurozone, and the UK that you see here actually have to do with the way the inflation basket is measured and the different weights given to different parts of the inflation basket. If we adjust for those differences, then we see a very, very similar evolution of inflation, with perhaps the US leading economic trends as it often does. The Federal Reserve seems to be reacting faster than the European Central Bank and the Bank of England to the fact that inflation is not transitory. And we're starting to see the first rate hike priced in for May or June of this year, of next year, so the first half of next year. More importantly, you heard Chairman Powell say the keywords that the word transitory probably needs to be retired. Inflation is not transitory, it's here to stay. And therefore, a faster taper in December could be discussed in December. And it looks like Powell himself, which up till now was considered one of the most dovish members of the Federal Reserve Open Market Committee, may be in favor of accelerating the cutbacks in purchases. The European Central Bank, on the other hand, is lagging as always, very slow to change in reaction to economic reality. It pushed back hard when investors tried to price in a first hike in the year 2022. It pushed back very hard. Now, no one is predicting in the markets a hike until 2023. Seems to be, frankly, completely behind the curve. It's still, as early as a couple of weeks ago, was using that transitory word that the Federal Reserve has already decided to retire. The Bank of England seems to be somewhere between these two. The communications are very confusing. A few weeks back, it seemed to imply, both the governor of the Bank of England and his chief economist, that they were going to raise rates, then they didn't. They seem to be very non-committal as to whether rate hikes are coming in December. It seems like February 2023 is the market's best guess as to when that first rate hike will be coming. We think that as bad inflation news continue to pile up, that might be a little bit too dovish. And we still haven't ruled out the possibility of at least a half of a normal hike at the December meeting. But again, this is probably the bank that is having a more difficult time transmitting its stance to the market. So with that, I think I will temporarily pass on the baton to Matthew, that is going to bring you up to date on the latest regarding this Omicron variant.
Yes, thank you very much, Enrique, and hi everyone. Thank you all for joining today. As Enrique mentioned, we're going to move on and talk about what has been really the main talking point in the FX market and indeed news headlines in the last week or so, and that is, of course, the detection of the highly mutated strain of COVID-19, now known as Omicron. Not a huge amount is known as of yet regarding this new strain of COVID-19, and that's created a great deal of uncertainty, and it's a cause of concern in itself, particularly among foreign exchange traders, which tend to react negatively to the unknown. What do we know? Well, we do know that it's the most mutated strain of COVID-19 detected to date, more than 10 times the number of mutations on the spike protein as the Delta variant, which is the dominant strain worldwide. That means that the Omicron variant may be more transmissible and may as well also potentially evade both immune response from previous infection and existing vaccines, which is providing a bit of a cause for concern. We have no real data on either just yet, although there are a few concerning signs that the mutation may be spreading quite aggressively in the likes of South Africa, where it's first detected, and in Southern Africa in general, and governments around the world have rushed to impose fresh travel restrictions on those countries worse affected. Although, of course, we've already seen the variants pop up in a number of countries around the world. I think earlier today, as many as 20 countries are now officially reported Omicron cases among their populations, and that number is undoubtedly going to increase in the coming few days. The key, though, or at least one of the big keys to how the market will react, we think is going to be the severity of illness caused by this new strain. So far, symptoms have reportedly been rather mild under the new strain, albeit so far it's a relatively small sample size. And indeed, most of the people infected with Omicron have so far been younger demographics, particularly in South Africa, where the population age, median age there is much lower than most other major developed countries. But the severity of the illness, as we find out more in the next few days, will probably be key, we think, to whether additional restrictions will be required. And of course, the subsequent reaction in currency markets. Now, this new strain may be everything to worry about, it may be nothing to worry about. If, for instance, it spreads relatively aggressively and more so than Delta and becomes a more dominant strain worldwide, but leads to significantly more mild symptoms and less chance of hospitalization and deaths, and is more of a sort of benign mutation, that could actually be a positive for the global pandemic situation. But that's, investors are not really taking anything for granted at the moment. This is just speculation as of yet. As I said, we know very little about the mutation itself, and that's created this great deal of uncertainty in the markets. And asset classes have reacted as one would expect. We've seen a classic risk-off mode in markets, particularly the end of last week. The traditional safe havens, the Japanese yen, Swiss franc, outperformed and rallied against all of their peers. Bonds also rallied as investors flocked to the low-risk investments, sending bond yields relatively sharply lower. High-risk assets as well have also sold off, as one would expect. Equity markets, as we'll get onto in the next slide, sold off relatively sharply. The S&P was down around about 2% on Friday, albeit still remains close to its highs and has since rebounded. Emerging market currencies also broadly sold off, led by oil-dependent currencies following a sharp drop in oil prices, and the South African rand after countries around the world rushed to reimpose travel restrictions on South Africa. But we note, and Enrique mentioned, that actually the moves we think have been largely contained. We saw a bit of panic selling in commodities, as we'll get to in the next slide. Oil prices were down sharply. Although if we look at most other asset classes, equity has rebounded and has remained close to its record highs. Among the major currencies, for instance, we look at the Japanese yen, which was one of the big movers late last week. Again, it's merely returned to levels we saw a couple of weeks ago. So the market's not getting too carried away just yet, awaiting additional news on the severity of the virus in the next couple of weeks or so before committing to significant positions in either direction. As mentioned, we did see a fairly sharp move lower in equity markets. You can see the S&P 500 was down around about 2% on Friday, although, as you can see, it has rebounded and recovered most of these losses. Oil prices, as I mentioned, have reacted slightly more aggressively as investors fear that additional lockdowns could be coming and a contraction in global demand could be on the way, which is generally a very bearish signal for oil prices. Brent crude oil was down around about 10% for the day, which, if we exclude March and April of 2020, the initial start of the COVID pandemic, I believe that was the second largest one-day move witnessed in the last 30 years. So a little bit of panic selling witnessed in commodities, and that has impacted commodity-dependent currencies, the likes of the Russian ruble, Norwegian krona, Colombian peso, have been among the underperformers. Although I think we're generally of the view that the moves have been perhaps slightly excessive and slightly overdone. We think that investors are perhaps trading more on uncertainty rather than any concrete bad news just yet. Hopefully, touch wood, this is merely an overreaction, and the new variant won't lead to new lockdowns. It won't have a significant impact on economic growth, and we expect risk assets to rebound under that scenario. And in fact, markets have calmed in the last day or so, and we've already seen signs of a rebound in most of these high risk assets. Among the major currencies, moves there have been rather interesting. The US dollar has actually fell on Friday on the news against both the euro and sterling. Now you would expect this the US dollar to actually rally in such an event during such uncertainty, given its safe haven status. Actually, we think that investors were trading more off central bank expectations more so than anything else. Investors were fearing that potentially lockdowns could be on the way, global growth could be slowing, and subsequently dialed back expectations in favor of central bank interest rate hikes across the board. Leading up to the Omicron news, market bets in favor of Federal Reserve rate hikes were quite lofty, following some strong US inflation data, some hawkish comments from FOMC members, including Chair Jerome Powell. Whereas in Europe, the ECB has remained very dovish. Expectations and market pricing for hikes from the ECB were already very low. So we've merely seen a closing in the gap between pricing for ECB hikes and Fed hikes. And that's provided a little bit of room for this move higher in the euro. Although again, we know the moves have not been particularly significant. The euro has merely returned to levels we saw less than a couple of weeks ago, around about the 113 mark against the dollar. What this does do, though, it does create a great deal of uncertainty going into the major G3 central bank meetings in December. The Fed, the ECB, and Bank of England will all be meeting on the 15th and 16th of December. And there is a great deal of uncertainty going into this. Policymakers may well see the Omicron news as a reason to hold fire for now on tightening policy and wait till 2022 before delivering some tightening of policy, or they could see it as nothing to worry about and go full speed ahead for tightening. But it is a particularly uncertain period, and we expect a high amount of volatility leading up to those central bank meetings and subsequently following those meetings in the next couple of weeks or so. In terms of what's next for Omicron, well, not a great deal is known, as I said, about the variant, and we expect news not expect news for the next sort of week, 10 days or so, regarding the three key aspects that we think both governments and health authorities and indeed investors will be looking for. First of which we think is its transmissibility. If the transmissibility is less than Delta, then it's unlikely to become the dominant strain worldwide. That could be supportive of risk assets. Second of which would be the effectiveness of the vaccines. Data on this is expected to take around about 2 weeks, so we'll have news on that, I think, in around about a week to 10 days or so. Again, if the effectiveness of the vaccine remains rather high against the variant, that could be supportive of risk sentiment. The vaccines can, of course, be tweaked, although there is a significant time lag for that to be the case, both developing the vaccines and then, of course, rolling them out. The last point here that we wanted to mention, and probably perhaps the most important of the lot, is the severity of the symptoms and the severity of the illness caused by this new strain. As I mentioned earlier, if actually the Omicron variant leads to significantly more mild symptoms, less chance of hospitalization and deaths, then actually this sort of a more benign mutation of the disease could be a positive of the global pandemic situation, and again would be a positive for risk sentiment. But again, a lot of unknowns. Investors are not jumping to conclusions. We expect volatility to remain high as we get news from health authorities and scientists regarding the severity of illness, its transmissibility, and the efficacy of the vaccines, as I said, in the next sort of week, 10 days or so. Now back to Enrique to talk about central banks.
Thank you, Matthew. Let's move on to the first slide, slide 15. And this is the story that is driving macroeconomic policy making worldwide. That this not forecasted inflation has been rising aggressively in most countries throughout the year 2021. Like we saw earlier, this is a global phenomenon with the possible exception of Japan. Everywhere else in G10 and emerging markets, inflation has risen to levels that we haven't seen for many decades. In retrospect, the reason is not hard to understand. We had a supply crisis, a crisis that affected mostly the economy ability to supply goods and services, and we responded. Governments worldwide responded by fighting the last war, reacting to what would have worked in the last crisis, which is pumping up demand. The net result is was initially general shortages and bottlenecks, and once it became clear that those shortages and bottlenecks are not going to be resolved immediately, we had widespread price increases. Commodity prices have risen sharply. Brent crude, even after the recent sell-off driven by the Omicron variant, is still it's close to 50% higher than the beginning of the year. And more importantly, there's been almost no withdrawal of monetary and fiscal policy accommodation. Government deficits remain huge, double digits in terms of percentage of the economy in the US, high single digits in the Eurozone. All of this combined with a monetary policy where rates are zero or below zero in most economic areas, and the central banks are pumping money by purchasing government bonds almost weekly. This jump in inflation has, far as to say that it has exceeded the central bankers' expectations, is a bit of it's a bit of an understatement, because as early as as late as April of this year, most central banks in the G10 were concerned with deflationary pressures. So they have been not just surprised, but completely blindsided by the key economic development of 2021. And they're only very slowly starting to respond by tightening monetary policy. Here, the comments from Powell from yesterday, where he says that it was time to retire the word transitory when it came to describing inflation, are quite key. And we expect all the central banks to follow suit. We go to the next slide. That is the main driver of currencies, the expectations of how fast and how much each central bank will hike. In the G10, the first banks to hike had been the Reserve Bank of New Zealand and the Norges Bank, which are probably the small economies that had a positive exposure to the commodities boom and therefore had run into supply bottlenecks first. The Bank of England and the Bank of Canada are expected next, the Fed very close behind. And as always, the European Central Bank and the Bank of Japan are expected to lag behind their peers. And this gap that is developing between the expectations for hikes in the US and in Europe is behind the sell-off that we have seen in the euro over the last 6 weeks. In emerging markets, central banks started to react to the increase in inflationary pressures much more aggressively, much sooner. In most of Latin America, for instance, unlike the G10, interest rates are already at or above inflation levels in those countries. And we think actually that this is a very positive environment for emerging market currencies that find themselves in cheap valuation levels and have the support of high interest rates in the respective countries, whereas the G10 banks are going to, we think that are going to be too slow. They're in raising hikes, in raising rates. This gap between interest rates in emerging markets and G10 does not happen often, and when it does happen, is conducive generally to appreciation of emerging market currencies, which is probably one of our biggest goals for 2022, as we will go over later. We go to the next slide. To focus on the US dollar, it has surged higher as the Fed has become noticeably less dovish over the last few weeks. As predicted, the quantitative easing program, in which the Fed buys a set number of government bonds every month, is going to start being tapered. Powell made it clear yesterday that if anything, that he expects the pace at which the bond purchases are curtailed to increase. We may be done as early as the end of the first quarter of next year. And as Powell has made it clear, immediately after the tapering program ends, they're open to hiking rates. Powell renomination, and when he, instead of the more dovish Lyle Brainard, is also another bullish sign for the US dollar. We have had a bit of an interference from the Omicron related sell-off, in that whereas the dollar has rallied against most emerging market currencies, it has actually sold off against the euro because the Federal Reserve, the calendar for Federal Reserve hikes was pushed back by markets, whereas the European Central Bank hikes are so far into the future they're much less affected. Regardless of this temporary blip against the euro, the US dollar index is currently trading around its highest level since July 2020. Rates in the US are back close to recent maximums. And this tells us that for the foreseeable future, currency markets will be driven by how quickly and how strongly the respective central banks expect to raise hikes. Okay, now let's talk. I'll talk a little bit more in depth about the Federal Reserve and the state of the US economy, and then pass the baton back to Matthew to talk about Europe and the Eurozone and the UK. The US inflation is at a 30-year high. Again, as is often the case, global economic trends show up first in the US, and then they move on across the Atlantic to the Eurozone and the UK. The headline rate of price growth is 6.2%. The monthly rate was 0.9%. So it bears noting that over the last month, rates are growing at a double-digit rate, and nobody's really expecting this to let up either next month or the month after that. More importantly, we cannot blame this spike in inflation on the commodity price boom, because core inflation that strips out the more volatile components, energy and food, has also increased to 4.6%. Again, the highest in 3 decades. And the Fed's preferred measure of inflation, the PCE index, which is even less dependent on commodity prices, has also jumped to 5% in October. It's worth remembering that the theoretical target is 2%. So an inflation that stays above 5% through any period length of time, it would be highly unwelcome, both politically and economically in the US. The increases in prices have been very broad-based, not just energy and vehicles, as seemed to be the case early in the month. Some people were dismissing inflation because it seemed to be mostly energies and new and used car prices. Right now, that's not the case. Most sub-indices are growing at 3% or higher. Shelter, housing in particular, is growing very fast. And the problem with shelter is that it's a highly sticky inflation rate, in that once it gets an anchor from the 2% target, it's very hard to bring it down. Powell this week, it cannot repeat it often enough how key it is to see Powell basically take back and acknowledge in a way his mistake, in that he will no longer use the word transitory to describe inflation. That is a massive shift in outlook from the Federal Reserve. So if you go to the next slide, the interesting aspect of this is that the inflationary boom is coinciding with very strong economic recovery. So what we're seeing is not really stagflation, as some were fearing at the beginning of the year, but a true inflationary boom out of the US. Macroeconomic data in the US has remained robust, thanks to, I'm not surprised, with the massively accommodative fiscal and monetary policies that we see. Consumer spending has been resilient despite higher prices, not just in nominal terms, which you would expect in an inflationary environment where prices keep going up, but also in real terms. So both volumes and sales and the prices at which each sale takes place have been going up. The PMIs, the indices of business activity, which are very, very important because they're the first, quickest read on the state of the economy. Most of the economic data lags weeks, months, even a quarter. The PMIs are immediate reads on how, on the pulse of business confidence, remained at very high index. In fact, the services index right now is at a record high. The US labor market is also performing well. Wages are rising sharply, though not as sharp as prices. This is important because it's kind of hard to reconcile the general political unpopularity of the bad poll numbers for the Biden administration with the fact that jobs are being created and wages are going up. Wages are going up, but they're lagging inflation. Unemployment has fallen. Jobless claims have declined to a multi-decade low. Everything's going well except that wages are lagging inflation. So the main beneficiaries of the ability to hike prices are corporations, are sellers of houses, are landlords, etc. All of this support the argument that inflation spike is not temporary. There's not going to be, we don't foresee a let up in this demand that is pressing up against supply constraints and driving up prices. So throughout the year, we have been calling for higher inflation that was expected by markets and central banks. We have largely gotten that story correctly. Within that story will continue into 2022. So if you go to the next slide. The labor market continues to be strong and continues to stoke inflation fears. Is creating roughly 500,000 net jobs per month, which is probably close to the speed limit, how quickly labor can be deployed in a productive manner in the United States. Unemployment has dropped to 4.6%. As quite a few workers, it's not clear why unemployment has dropped so quickly when the number of jobs still hasn't recovered to pre-pandemic levels. One of the explanations is that many older people have chosen to retire, taking advantage of the pandemic to hit early retirement. Now, the key number is at what point unemployment, how fast can unemployment drop before this bottlenecks become widespread and before workers can start pressing for higher wages above the growth of productivity, which would stoke further the inflationary pressures. There seems to be some signs that we're close to that level, that around 4.6%, 4.5% may be as fast as unemployment, as low as unemployment can drop in the current situation. But there's a lot of uncertainty around the number. Let's not remember that before the pandemic, we were below 4% without there appearing significant price pressures. So in addition to inflation driven by supply chain bottlenecks, the key story for 2022 is how much further can unemployment drop before we get a second win on inflationary pressures. Go to the next slide. The Federal Reserve, which was very skeptical that inflation was going to be a problem for most of the year, appears to have done a 180-degree turn, appears to be now more and more concerned about inflationary pressures. Consequently, in November, we saw the first step towards normalization of monetary policy, in that the amount of treasuries and mortgage-backed securities that are purchased every month will come down by $15 billion per month. At this pace, this would mean that it would stop buying treasuries and bonds altogether in June of 2022. However, Powell clearly sounded more concerned about inflation this week, explicitly opened the door to faster removal of stimulus and an acceleration of the taper as early as December, which could see the program taper down completely by as early as March of April of next year, which would open the door for a second quarter hike. Again, the Powell's comments on U.S. inflation were rather dovish back in November, but he seems to have clearly changed his tune as to this week, as the latest numbers of inflation for October were quite ugly, and seemingly has led Powell and some of the other members of the Federal Reserve to change their minds on the situation. And for more detail, let's go to the next slide. Matthew, can we go to the next slide? Matthew? Aha, here we go. It's notable that a number of the members of the Federal Open Market Committee members, which are the ones who get to vote on Federal Reserve policy, have actually gone from being the most dovish to being pretty hawkish and pretty concerned about inflation. Bullard, in particularly, was one of the proponents for more aggressive purchases and monetary policy back 2 or 3 years ago, and in response to the pandemic, and he seems to have turned around by 180 degrees, and now has become one of the most hawkish members of the Federal Reserve Open Market Committee. More importantly, Powell, who still seems to command the respect of the Federal Reserve Open Market Committee, and still manages to get unanimous votes, has explicitly said that has taken back the word transitory. He seems to be implicitly acknowledging his mistake. And we think that the December meeting is going to be quite interesting. I think there's going to be quite a bit of dissent for the first time in years in the Federal Reserve. We're going to have some heated discussion between those and the hawks. And given Powell, Bullard, Bostic, and Clarida's turnaround towards more hawkish positions, we expect the December meeting to result in a faster pace of the tapering process, and perhaps some hints that hikes could be coming as early as the second quarter of next year. Of course, all of this is highly dependent on how the Omicron variant evolves. But if our view that both the economy and health, the economic authorities and health authorities have become more adept at handling problems that are from the pandemic is correct, then we think that we may see an acceleration of this type of tapering announced in December from the Federal Reserve. If you go to the next slide, again, markets have ramped up their expectations for U.S. interest rate hikes. The spread of Omicron tempers such bet temporarily. Yesterday and today, we've seen markets go back and price back in this acceleration of the timetable for hikes. Future markets are pricing 2 hikes in 2022, one at the May meeting, one at the September meeting, a third possible in December. We think we're getting close to pricing in a realistic scenario. However, my personal view is that if anything, we're likely to see this, the markets price even more hikes. We might even, I don't think it's out of the ordinary that by December, we'll see 4 full hikes priced in 2022. That would be that from the current 65 to 70 basis points of hikes in 2022, we might go all the way to 100 basis points. And we go to the next slide. The December Federal Open Market Committee meeting will be key. Discussions on faster taper at November meeting would, in my view, will result in an acceleration of the pace of tapering purchases. Inflation is now at 6%. There'll be one more data point before the December meeting. All predictions are that if anything is expected to go up somewhat for current levels. The labor market in the US continues to be strong. The close nature of the US economy means that any international fallout from the Omicron variant will have, in our view, very little impact on the US labor market over the next 2 months. And I think that the Federal Reserve will transmit that is ready to taper completely the purchase of additional bonds and treasuries at some point in early second quarter of next year, to be followed immediately by the first rate hike. The key source of uncertainty for this decision remains the economic impact of the Omicron variant. But we think that, again, it's important to remember that the US economy is relatively close, and that the variants, like the Delta variants, had very little impact, and the politically lockdowns in the US are extremely unlikely. So between now and December, it's very difficult to foresee Omicron having any significant impact on either inflation numbers or labor markets out of the US, which is what the Federal Reserve looks at to make its decisions. And with that, I will hand over the presentation to Matthew, who will explain the dramatic contrast between this increasingly hawkish Federal Reserve and the much more dovish European Central Bank, with the Bank of England somewhere in between.
Yes, thank you, Enrique. As Enrique just mentioned, one of the key talking points in the FX market in recent weeks has been this divergence we've seen between the ECB and the Federal Reserve. The Fed has been largely hawkish, as we've talked about, indicating rate hikes are on the horizon next year, whereas the ECB has been ultra dovish, and one of the most dovish in the G10, and that's led to this relatively sharp sell-off we've seen in euro-dollar in recent weeks. Actually, we think the ECB stance is perhaps overly cautious. If we look at Eurozone inflation, we're seeing similar patterns to what we've seen in both the US and the UK, albeit slightly lagged relative to the US and to a slightly less extent so far. But headline inflation did rise to its highest level in 30 years in November, up to 4.9%. The typically less volatile measure of core inflation, which is the measure that the ECB looks most closely at when deciding its policy, that also jumped above the ECB's 2% target for the first time since 2002 to 2.6% last month. In fact, I think that was its highest level since 1996. Part of this increase in price pressures has to do with the low base effect. Demand contracted significantly last year due to the lockdowns that were in place, and that led to a slowdown in price growth. Hence why we're seeing a little bit of a distorted increase in prices this year. But the argument that rising prices is driven predominantly by the base effect is wearing increasingly thin. If we look at the month-on-month measures of inflation, particularly sort of moving averages of monthly increases in inflation, we are beginning to see signs of an uptrend in price growth. So far, the ECB, though, has continued to stress its view that this spike in inflation is temporary. It will look through it when deciding its next policy stance, or next policy change, I should say. President Lagarde has been dovish on inflation for a while now. She stated at the end to the recent cut in German sales tax could be one of the reasons as to why this spike in prices will be transitory. But we're of the general view that the ECB is underestimating the extent of this overshoot in price pressures, particularly given the supply shortages, which have dragged on longer than expected. Energy prices, for instance, continue to remain elevated, even following the recent move lower in oil. And we're generally of the view that this ECB's transitory view and transitory argument on inflation is wearing increasingly thin. Having said that, a reason and probably a good rationale for the ECB to remain at least slightly cautious when deciding its next policy move is this recent sharp increase in virus caseloads that we've witnessed across much of the European continent, which is expected or could potentially weigh on growth in the next few weeks. We've seen a handful of countries experience sharp increase in caseloads in the last few weeks, notably in the likes of Germany, which is experiencing record daily high levels of infection. New lockdowns and restrictions have been reimposed. Austria and Slovakia have gone into full nationwide lockdowns. The Netherlands has enforced a partial lockdown. Other countries have tightened restrictions, the likes of Portugal. Germany looks likely to potentially follow suit, while others have imposed additional curbs on the unvaccinated. And that's just generally raised concerns that growth could be set to slow in the coming weeks, particularly if additional restrictions are imposed on a more widespread basis. So far, however, as we've mentioned, data out of the euro area has been largely resilient to these additional restrictions. The composite PMI, for instance, which is a weighted average of activity in services and manufacturing sectors, has remained very resilient. Actually rose for the first time in 4 months in November to 55.8, which is comfortably above the level of 50 that denotes expansion. We think that this may prove short-lived. The December number could reflect slower growth, particularly again if we see additional countries following suit with the likes of Austria and Slovakia. But we think that the downturn will be much less severe than what we've seen in the past 18 months during the previous tightening of restrictions. We expect the additional measures to be much more mild. And also, of course, businesses are adapting much better to these lockdowns than they did certainly at the beginning of the pandemic, which should mean that this slowdown that we do get, if we do get one, we think will be relatively minor. The ECB has, however, continued to remain very dovish, as we've said. It kept policy unchanged at its last meeting in late October and struck a pretty dovish note on inflation. The ECB continues to expect inflation to ease next year and crucially remain below the 2% target over the medium term. Lagarde has also been very dovish on interest rates. At the October meeting, she pushed back on market pricing for hikes in 2022. According to Lagarde, the condition for a lift-off in rates was not satisfied, nor will it be next year. The markets actually initially ignored her comments, but have since come around to the view that hikes next year are unlikely and are now not pricing in a rate increase until 2023. We have had some hawkish comments on the PEPP program, which is the Emergency Pandemic Asset Purchase Program. Lagarde now expects that to end as planned at the end of March. There were some that expected a short extension, but it looks likely that we're going to get official confirmation that it's going to end in March at the December meeting. Since the October meeting, though, Lagarde has continued to strike a dovish tone, particularly on inflation and interest rates, stressing that the outlook for inflation remains subdued over the medium term. The conditions for rate hikes are unlikely to be met next year. And as you can see, the market has reacted by lowering its bets in favour of ECB rate hikes. And the market is now pricing around about 5 basis points of hikes from the ECB through to the end of next year, which is significantly lower than what we saw prior to the ECB meeting in October. And significantly less than what we're seeing in most major nations, particularly the likes of the Federal Reserve, for instance, in the US. There's now a very large gap between market pricing for the Fed and the ECB, which could actually provide a little bit of support for the euro, should we see a narrowing in that gap. And there's perhaps a bit more scope for a narrowing in that gap than a widening over the next few months or so. So what can we expect from the ECB meeting this month? Well, the ECB meeting will take place on 16th of December. We expect Lagarde to announce that the PEP program will end as planned at the end of March, which might be a little bit of a hawkish signal for markets. But what we do expect Lagarde to acknowledge as well that inflation is now closer to the 2% target over the medium term than it was at the previous meeting. Again, another potentially hawkish signal for markets. But we don't expect a strong hawkish tilt from Lagarde. There are a number of uncertainties that remain. virus caseloads, as I mentioned, have risen quite sharply in Europe. A host of countries have reinforced lockdown measures. The Omicron variant, of course, presents an element of downside risk and has clouded the near-term outlook. So we don't think the ECB will want to rock the boat too much. We think they'll state that the PEP program will end in March. They may revise upwards their view on inflation and inflation projections, state that it's becoming closer to the target over the medium term. But we think they're likely to stress that hikes remain a long way off, and still don't expect them to acknowledge or believe that rate hikes will come until at least 2023. So that could potentially provide a little bit of a downside to the euro. As far as the euro is concerned, well, as we've been talking about, the euro sold off quite sharply in the past few months. Certainly since the beginning of November, we've seen a fairly significant move where the euro dollar has fallen from around about the 116 mark to now currently trade around the 113 level. We have seen a little bit of a bounce in the last few days, although the move has been a fairly minor one. As I mentioned, we think that there is potentially a scope for a narrowing in the gap in market pricing between Federal Reserve hikes and ECB hikes next year, given that that gap is now relatively large. So that could be supportive of the euro in the coming months. But as Enrique was mentioning, the chances of greater lockdowns in Europe are now greater than they are in the US, and have been during most of the pandemic period, particularly with virus caseloads rising aggressively in Europe, the Omicron variant. There is a chance that we could see more downside in Eurozone growth due to these lockdowns than in the US, and that does present a little bit of a downside risk. So there's a lot of uncertainty as far as euro dollar is concerned, particularly heading in to the ECB meeting in a couple of weeks' time. We're going to move on to the Bank of England now and sterling. And the Bank of England's remained one of the more hawkish G10 central banks in the past few months. We're seeing a similar picture in UK inflation as to what we've witnessed in the US. Headline inflation has risen quite aggressively up to its highest level in a decade, 4.2% in October, which is obviously now comfortably above the Bank of England's 2% target. Core inflation's also jumped, that's at a decade high of 3.4%. And the Bank of England has continued to revise higher its inflation projections. Now expects inflation to peak at around about 5% in April 2022. We actually think that risks to inflation are still skewed slightly to the upside, more so than to the downside. Demand remains robust in the UK. You see latest retail sales exceeded expectations, 0.8% month-on-month growth versus a flat reading expected. The labour market has also performed very well. At the October labour report, we saw an increase in wage growth, an increase in employment, despite the end of the furlough scheme at the end of September. So we remain generally of the view that demand will remain well supported. That presents a bit of an inflationary environment, and risks to upcoming inflation prints, we think, probably skewed to the upside, more so than the downside in the UK. Despite this increased inflation, the Bank of England held policy steady at its November meeting, which was a bit of a disappointment for markets, and sterling sold off rather sharply following the announcement. Leading up to the meeting, investors were fully pricing in a 15 basis point rate hike, and economists were largely split down the middle as to whether we would get a hike, but at the very least, they expected quite a close vote. In fact, we didn't get a close vote at all. The vote was split 7-2, with just two dissenters voting in favour of an immediate hike, Messrs Saunders and Ramsden. Governor Andrew Bailey surprised the market in not voting for an immediate hike, despite some very hawkish comments leading up to the meeting. The tone of the communications was also dovish, again, which was a disappointment to markets. The MPC continues to view this spike in inflation as temporary, which to us signals a pushback on market pricing for hikes. And they stressed that there was value in waiting for additional data, particularly on the labour market, before deciding on the need to raise interest rates. So that possibly signalled, we think at the time, that the market was, or that the Bank of England was on course to raise interest rates in December. But of course, as we've been talking about, the Omicron variant and the emergence of the variant has created this additional uncertainty, which makes a December rate hike increasingly less likely from the Bank of England. We've seen a retracement in market pricing for rate hikes. The market is now pricing in around about 9 basis points of hikes by the end of this year, which is down from 13 prior to the Omicron news, and just 25 basis points of hikes through to the end of February from 29 prior to Omicron. Upcoming data releases remain key, particularly on labour, the labour market and inflation, and those will be closely watched by policymakers. But regardless of the strength of that data, we think that a December hike is now looking perhaps a bit unlikely for two main reasons, really. First of all, the meeting is very close to the Christmas break. The Bank of England may wish to avoid creating too much volatility in the markets leading up to the Christmas period. The second one will be, of course, the detection of the Omicron strain and the potential downside risk that could create to the outlook. So a December hike may be slightly premature. We're looking more at a February rate increase as more likely. And in fact, we've seen some dovish comments from some MPC members in the last few days. Catherine Mann, as one of the voters on the MPC, said yesterday that it was premature to talk about raising interest rates. We think there are enough doves on the committee that support that view. That's likely to ensure we get no hike in December, and probably will have to wait until the February meeting for the next rate hike. But what can we expect from the Bank of England at this December meeting? Well, as I said, we're of the view that the MPC is probably likely to hold fire for now. It may well insist on a wait and see approach as it awaits more economic data on inflation, the labour market, and in particular, the potential economic impact of the Omicron variant. We think there's enough dovish members on the committee in order for a hike to be delayed to February. But we're still pretty confident in our view that we will get a 15 basis point hike at the February meeting at the very latest, bringing rates back up to 0.25%, with additional hikes to follow in upcoming meetings after that. The market is still pricing in 4 rate hikes from the Bank of England in 2022. That would be a much more aggressive pace than a lot of its peers, and that could be supportive of the pound next year, which we're still pretty bullish on, and we're still pretty optimistic on its prospects over our forecast horizon. As far as sterling is concerned, well, we've seen a sharp move lower in sterling against the dollar. It's trading around about the 132 level against the dollar at the moment, largely we think due to heightened bets in favour of Federal Reserve rate hikes. Actually, in trade-weighted terms, sterling continues to hold its own. It's traded largely within the sort of 81 to 82 range, the trade-weighted index, which is largely unchanged from late February levels. And actually, sterling remains one of the better performers year to date. I think it's only Canadian dollar and US dollar that's performed better. As I said, provided that the Bank of England raises rates as we expect in February and then follows this up with subsequent hikes, we think that's a bullish environment for sterling. We're still pretty optimistic on the pound going into 2022. And now we're just going to wrap up here and talk about our expectations briefly for next year. And we've talked a lot about our expectations or what we've seen in the market in the last few weeks and what to expect from the December central bank meetings. But what are our expectations for next year? Well, we've outlined here what we think are probably be the 4 main drivers for currencies in 2022, of which we've already discussed in detail so far. First of which we think will be government response to the COVID variants, including Omicron, dependent on the severity of that particular strain. We may get additional restrictions in the coming weeks. That'll be closely watched by market participants. And of course, this may not be the last variant of COVID-19. We may get additional ones in next year, which will be closely watched by investors, as of course will be the continued rollout of vaccines. particularly in the developing world, has lagged behind much of the major nations. We've had a view for a while now that we think that the continued rollout of vaccines in the developing world should be good news for risk sentiment. It should be good for global growth, and should be, again, supportive of our call for stronger emerging markets on the whole next year. But hopefully the main focuses will be away from the pandemic and more on what we think will be the global inflation dynamics and central banks' response to rising inflation, particularly the timing and the extent of an easing in price pressures next year. As we've said, we think that most central banks are still underestimating the overshoot in recent inflation prints. So the timing of an easing in price pressures will be key, as will how central banks respond to it. We think that those central banks, or the currencies whose central banks are raising rates sooner and to a more aggressive extent, are likely to see their currencies outperform those currencies whose central banks are delaying interest rate hikes and are taking a much more gradual and cautious approach to normalizing policy. We think that their currencies are probably likely to underperform over our forecast horizon. And that is everything from us in terms of content. We've run a little bit over time, but hopefully there's enough time for any questions that you might have. There is a Q&A function in the Zoom chat. So if you do have any questions, please feel free to type those in now and we'll try and get around to answering them.
Okay, there's one that's interesting. Did the basket used for the PCE index change in the last year? The PCE is one of the indices of inflation in the US, and it's the one that the Federal Reserve is supposed to pay the most attention to. It's revised periodically, but to our knowledge, the revisions are fairly minor and definitely nothing that could explain that you could ascribe the surge in inflation to. The surge in inflation that we're seeing in the US and everywhere else is genuine, is broad-based, and no matter what, in any set of sub-indices that you can make, you will see the vast majority of them going up at anywhere from 3 to 20% a year. So we don't think that that this can be that inflationary pressures can be ascribed to technical issues like that. It's a genuine it's a genuine inflation surge.
Yeah, I would wholeheartedly agree with that. We have a question on what is our expectation for euro dollar? Would you like to answer that one, Enrique?
So which one? I'm not sure I see.
Yeah, sorry, it was in the chat function. So what our general expectations are for euro dollar?
For euro dollar, we have revised our expectation down for euro dollar. We were surprised by the extreme dovishness of the European Central Bank and the lack of any pushback from the traditionally more hawkish members of the council, the ones that hail from not just Germany, but the Netherlands and Finland. We think that the euro is relatively cheap at current levels. We think that, for instance, over the long term, the fiscal deficit in the US, the structural fiscal deficit and the tendency to run deficits over the very long term should be a net negative for the US dollar. But over the short and medium term, we won't see any sustained rebound on the euro until we see some significant pushback from within the European Central Bank Council about inflation and the appropriateness of this very aggressively dovish stance in the face of increasing inflation. We think that the recent coalition government in Germany with the FDP, the liberals, which are traditionally on the hawkish side of German politics, taking over the Ministry of Finance could be a first step, but we won't see a rebound in the euro until we have some significant pushback from the Bundesbank, of the German members of the council, about inflation and the appropriateness of having a monetary policy rate that is 4 or 5 or 6% below the inflation rate.
I don't know if we have any additional questions from anyone. If you do have any, please feel free to write them in the Q&A section. Oh, we do have one. Our expectations for the Canadian dollar against both the US dollar and the euro.
I'll let you take this one.
Yeah, I mean, Canadian dollar, interesting way, is one of the currencies, particularly the G10, that's driven most predominantly by changes in oil prices. Actually, our view on commodities is a relatively positive one, where I think we're generally optimistic on the global economy on the whole, and that's generally supportive of oil prices. So I think we'll get a little bit of a bit of support for Canadian dollar from oil, which has retraced in the last sort of week or so. So room for a bit of upside there. But on the other hand, I think the Bank of Canada, expectations for Bank of Canada hikes are already quite elevated. Unlike, say, the ECB, where rate hike expectations are very low, actually the market is pricing in already quite an aggressive pace of hikes from the Bank of Canada. So that provides a little less scope for a move higher in, say, the Canadian dollar than we would potentially see in the euro. Actually, I think hikes from the Bank of Canada are largely priced in, so that could present a little bit of a downside. In terms of our view of Canadian dollar against the dollar, I think we're slightly bullish on CAD versus USD, albeit we expect it to be one of the worst performers in the G10 versus what we think will be a broadly weaker US dollar. And against the euro, I think we're generally of the view that euro will the scope for a little bit of gains in the euro against most currencies, particularly Canadian dollar, given our view that perhaps the sell-off in euro in the last few weeks or so has been perhaps a little bit overdone. I don't know if we have any other questions. If not, perhaps we can wrap things up there, Enrique. We're overrun a little bit.
So. Thank you for your patience. I hope that this was useful and that you will join us at the next one.
Yes, thank you, everyone.
Thank you. Bye-bye.
Bye.